Welcome everyone to Vested Interest. This is Shane back again for another stock pick of the day video. It is April 25th. Yep, pretty close to wrapping up another month. Can't believe it. Already into May almost. Next week will be May. We are going to take a look at MSCI. This is out of the financial sector here. This is a company that was recommended by Trevon. I think I'm saying that right. Trevon, I think. Trevon Carter commented, great video. Can you do a review on MSCI? They were down 13%. Must have been a big drop here recently. They were down again today. So I thought we'd take a look at them. Again, they are out of the financial sector. And if you are new to the channel or just have not taken the seconds that it takes to do so, go ahead and hit that thumbs up down below if you find any value in the content. Most importantly, hit that subscribe button. Join us on this journey to financial freedom. Join the vested interest community. Hit that notification bell so you're notified whenever we put out any new content. And speaking of new content, we will have our portfolio update. We do those every Sunday morning. So another reason to make sure you hit that subscribe button and hit that notification bell. Every Sunday morning, 7:30. So we cover all the stocks that we bought for the week, any options we were in, any dividends that were paid out. If we happen to have any sales, that don't happen very often, but every now and again, we do make some sales in the portfolio, and then I reallocate funds. I'll show that as well. And drop a comment down below. Let me know what you think of the video. I'll have a couple other new videos coming up here. We'll probably put one out. Tomorrow's Friday, so let's say Saturday. I'll put out the stocks I'm looking to buy in May, what I'm going to focus on for the month of May. Yeah, we're turning the calendar to another month. And then probably next week, I'll wrap up April and cover all of the dividends, do the dividends and options recap for the month. So probably next Saturday, do that. Again, just one more reason to hit that subscribe button, join us on this journey to financial freedom, join the vested interest community, hit that notification bell, and drop a comment down below. Let me know what you think of the video. Let's continue on. This is the vested interest stock screener. This is how I look at a company on a high level, see if I'm interested in investing. If it meets 5 of 8 or 6 of 9, if it's a financial company, I use price to book primarily for banks. You can use it for any company, but make sure you're comparing, if it's not a bank, that you're comparing price to book of that company with other companies in the same sector. If it meets 6 of 9, it does not necessarily mean that I am investing in that company. It just means it goes into my watch list and I do more of a deep dive, do a discounted cash flow analysis, see what I'm willing to pay for it, and then wait for it to come into value with what I've decided I'm willing to pay for. Typically within 15% of its 52-week or low or lower. That's why I have that. Buy below current cost basis or within 15% of its 52-week low, right? This is also how I set up the video, so we're going to run through this criteria with this company as well. And if you want to know more about this company, check them out at www.msci.com. MSCI is a leading provider of critical decision support tools and services for the global investment community. That's you, if you're an investor. With over 50 years of expertise in research, data, and technology, we enable clients to understand and analyze key drivers of risk and return and confidently build more effective portfolios. Clients use our industry-leading research-enhanced solutions to gain insight into and improve the investment process. At MSCI, we strive to bring greater transparency to financial markets and use innovation to drive global economies. Healthy economies stimulate job creation, encourage infrastructure development, and generate the returns necessary to improve living standards for everyone, everywhere. So that's really their bread and butter, right? They are an investing tool. They are providing data, analyzed data for you. I don't know if it's a membership base where you're paying monthly or weekly or how they're setting up their standards, but obviously someone, either individuals, companies, are paying for their investment tools and data and technology that they provide so that you can, as an investor, make more informed decisions, right? So that is their bread and butter. That's what they're into. Might be worth looking at them, even if you don't buy the stock, just to see what kind of tools and data they are providing, what the cost basis is. I did not look that deep into it, but that's what they're doing. Now, the reason we're taking a look at them, they were down slightly today, 0.03%. And again, since Trevon, I believe it's Trevon, recommended it, I thought even though that's typically I like more of a pullback, but we're going to take a look at it anyway. We are talking about MSCI Inc, ticker MSCI, again out of the financial sector. Closed out the day at $464.49 per share. 52-week low as low as $439.95, as high as $617.39. Definitely closer to their 52-week low than their 52-week high. Market cap of $36.799 billion. a beta of 1.04. So just slightly more volatile than the overall market. PE ratio seems elevated here at $31.73 per share. Price to earnings, that's a little high. Now, I don't know about a lot of companies in this type of market here, so it may not be high for what they're providing for financial companies. You know, you typically use price to book, but since they're providing information and analysis, I don't know that you compare them to like a bank. So I need to do more research, find some other companies like this and see what their price to earnings ratio is, what their price to book is, and do a little bit more deep dive on that. But that's typically a little higher than what I like to pay. It is higher than the overall market. I think the market's around 21 to 23 right now. So it is a little elevated in my opinion. This would be more in line with like a fast-growing technology company, you know, like a Meta or Microsoft or Google, something like that usually has a higher PE. So this is a little high for my liking. EPS is very high. Earnings per share sitting at $14.64 per share. That's high. That's a very good earnings per share there. Earnings date, sometime between July 23rd and July 29th, so tune back into that. Forward dividend is $6.40. I believe they're a quarterly payer, so divide by 4, though we'll see that here in a little bit. Now, they do have a little low on the starting dividend yield at 1.38%. That's lower than I like. I typically like, you know, something in the 2% or higher range. I do have a few that are down in the 1% range. But not very many. Most of mine are 2% or higher. 3% or higher is really where I like to be, but I don't mind some lower if they're fast growing, right? Ex-dividend date, May 16th. Looks like they're going to pay out, ex-dividend date, well, it looks like they paid out in February. So their next dividend date is in May. I would assume they're going to pay out in June, right? 1 year target estimate, at least according to Yahoo Finance, where I pulled this information from, $543.80. So they don't see it getting back to its 52-week high, but they do see some upside as far as price appreciation, at least according to Yahoo Finance. I'm not affiliated, just as one of the sources that I like to go to for information. And if you were to go to yahoofinance.com, you could go to the left here, and you'll see a lot of different tabs: analysis, statistics, financials. For us, we're going to go to statistics. We're going to go down to dividends and splits. We're taking a look at dividend yield theory here. We look at the 5-year dividend yield average of 0.87%. We compare it to its current 1.38, or over here where it says forward 1.38, same number. And since it is higher, significantly higher actually, that speaks to undervaluation for this one. So this one, according to the dividend yield theory, is not only undervalued, but it is presenting a bit of a margin of safety right now, which is nice. Now, another thing, and that's what I'm looking for. I'm looking for a margin of safety, dividend yield to tell me that it's undervalued. That's where we're starting at. Again, I want to do a discounted cash flow analysis to get more info of what I'm willing to pay. But so far, according to discounted dividend yield theory, this one is potentially undervalued. Now, payout ratio, I like 75% or lower. This one's very low at 39.21%, so that gives them a lot of room, even though they're starting with a low dividend yield. This gives them a lot of room to increase that. And we'll see how fast they're increasing that here in a minute. Now, again, if you were to go to Yahoo Finance, go over here on the left, you click on financials. We're going to look at free cash flow, but there's a lot of good information under the financials tab. You can look at their balance sheet, their income statement, their cash flow, which we're going to look at. You can check out their debt to equity ratios. You can look at their assets over liabilities. Make sure they have more assets than liabilities. Make sure that they're paying down their debt. Are their margins growing or are they shrinking? Is their revenue growing or is it shrinking? Is their free cash flow, which is what we're going to look at, growing or is it shrinking? We want growing free cash flow because typically if a company has growing free cash flow, they have growing dividends to match. So going back to 2020, you see $760 million here. 2021, $883. 2022, $1 billion. 2023, $1.1 billion. Nice, steady free cash flow growth. Not only nice, steady free cash flow growth, but you can see they are repurchasing their own shares as well, right? Some years very aggressively. 2021, very aggressive year. 2022, even more so. Bit of a drop back in 2023, but overall, very nice, steady free cash flow growth as well as repurchasing the shares. And the reason you want a company repurchasing shares as opposed to diluting you, unless it's something like a REIT or a business development company, some other companies that use stock dilution or throwing more stocks into the system so that they can invest back into new purchases. Those companies are all right. For the most cases, you want companies to either have their stocks remain flat or like this one, repurchasing their shares, because that makes you more of a shareholder over time as they repurchase those shares, even if you don't add more capital. Now, another source of information that I like, stockanalysis.com. You pick any sources that you like. I just recommend more than one so you can make sure the information you're getting is accurate and up to date. Now, they have 12 analysts that have taken a look at this. They call it a consensus buy, though it is right on the edge of a buy and a hold, right? If you were to go to stockanalysis.com, you could click on each one of these. This is a strong sell, hold, buy, strong buy. So in their opinion, at least the majority of the 12 are saying it's a buy, though it is right on the edge there, right? Low estimate of $425, that would be a 8.45% decrease from where it currently sits, and obviously that would be a much better entry price. You'd get a little bit higher dividend yield, even though dividend yield theory right now says it's undervalued. It would be even more, at least according to dividend yield theory, a little more undervalued. Average estimate $571.67, which is pretty close to what Yahoo Finance had on the previous page, which would be a 23.15% increase from where it currently sits. And if it happened to hit their high, pretty close to its 52-week high, that would be $660. That would be a 42.18% increase. Now we're going to get into statistics here. We're going to look at return on equity and return on invested capital. I like 10% or better here. Return on equity, negative 128.4. I'd have to get into the financials and see what's going on here. I don't like that negative number, especially with a company that's providing data, software, that sort of thing. So maybe they've had some recent data expenses. Not sure why they would be negative for a company like this. You know, it's not like they're building new manufacturing plants or anything like that. So return on invested capital is good, though, at 29.64%. Again, I like 10% or better. Now, they did not have EPS growth. Trevon, if you happen to know that, if you could post it down below, that'd be great. Revenue forecasted growth is nice at 8.57%. Let's look at the dividend real quick. All right, again, yep, quarterly payout ratio. They're saying 43.69%. Yahoo Finance said 38%. Either way, you know, I like under 75%, so this is very low in my opinion. Anything under 50 is low. Dividend growth of 13.31%. There you go. Double-digit dividend growth. So even though they have a bit of a low starting dividend yield, double-digit dividend growth, this might be a good one, especially if they maintain this dividend growth for the next, 10, 20 years with a low payout ratio like this. This would be very nice. You could get a very good return on your initial investment here. They have 10 years of dividend growth. That's nice. So a decade or more is always good, though, you got to start somewhere. So just because a company might only have 1, 2, 3, 5 years of dividend growth, don't dismiss it. 10 years or better is nice, but I don't really have a hard and fast rule. They've got to start somewhere. A company that's been growing its dividend for 70 years still had to start in year 1, year 2, year 3, right? Buyback yield of 1.21%, shareholder yield of 2.58%. Going back to November 10th, 2021, they were paying $1.04. Raised it up August 2022 to $1.25. February 2023 to $1.38. Most recently, February 2024 to $1.60. I would not anticipate another raise until next year around the February timeframe, though they have raised it in August before, so you never know. Right? They were pretty aggressive in 2022, raised it up, and then right again in early 2023. So you never know, but I would expect if they're going to maintain their dividend growth, it's going to be February of 2025, right? Well, that is it for this one. Trevon, thank you for the suggestion. Really appreciate it. MSCI, let me know what you think about it down in the comment section below. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you have a company like MSCI you'd like me to cover in the Stock Pick of the Day series, go ahead and drop it down below, and I'll work it into the rotation. And this is Shane, signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Again, don't forget, Sunday morning, we've got our portfolio update, so tune back in, hit that notification bell so you don't miss that. And thank you for joining. We'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk and money to never invest any amount in comfortable losing. Always do your own research, invest based on your situation, circumstances, and select criteria, or seek the advice of a certified financial advisor.